What's up, guys? I'm Kay Scholl. Welcome to another financial awareness video. So I've made several videos about self-employed taxes, business deductions, and about what your options are specifically regarding writing off your vehicle for business purposes. However, just sharing your options with you isn't the same as sharing what I've chosen to do. So in this video today, I'm going to share with you why I chose not to write off my vehicle through Section 179 and why I chose to use the standard mileage rate method. My goal for you, and I think the value you'll get by watching this video, is conviction around your own decision about whether or not it's best for you to take Section 179 and write off your vehicle through the actual expense method, or if you think the standard mileage rate method is best for you in your situation. Okay, let's get to work. So no, I did not write off my vehicle purchase back when I bought my vehicle in 2015, and I was inspired to make this video because of a few conversations I've had with other small business owners and self-employed people over the past couple months. Let me first share that there are absolutely several scenarios and many situations where writing off your vehicle purchase and using bonus depreciation makes much more sense than using the standard mileage rate method of deducting your vehicle. 100% that's true. However, for me, in my situation, I've done really well over the last 6 years using the standard mileage rate deduction, and here are my thoughts. As my buddy Dave says, anything with an engine in it is gonna go down in value. So why waste your money on something that will go down in value? Good question. As a self-employed business owner, you should focus more of your time, energy, and money on things that will increase your business enterprise or increase your business revenue, as opposed to being a financial burden on your business. I'm sure you've heard, just like me, that the moment you drive that brand new vehicle off the lot, it drastically depreciates in value. So the last 2 vehicles I've purchased have been certified pre-owned or used. The vehicle I'm driving now is a 2014 Jeep Grand Cherokee that I purchased used in 2015, and I bought it for, wait for it, $24,600. Is this not ridiculous? Do they even still print on paper this long? It's crazy. Anyway, after about 2 years, a little under 2 years, I had the vehicle completely paid off. So for the past 4 years, I've had no car payment, which has been really nice. Now, this particular SUV has a gross vehicle weight rating of over 6,000 pounds. So had I used Section 179 and some bonus depreciation, yeah, I would have gotten a really nice tax write-off in 2015 when I placed this vehicle in service for my business. I would have gotten about 75% of $24,600, which would have been $18,450. Now, I say 75% because I do sometimes use this vehicle for personal use, about 25% of the time. So I would have only been able to get about a 75% write-off based on the actual vehicle expenses and Section 179 and writing this vehicle off. In addition to writing off the purchase and some of that bonus depreciation, I also could have written off all of the actual expenses that I've incurred over the past 6 years to maintain this vehicle and keep it operational. Now, each year's been a little bit different, but basically, here's what it would have looked like on average. $10,800 worth of gas, $1,500 worth of buying new tires, $3,000 worth of oil changes and other maintenance. This would have come to a total of $15,300, and I could have written off 75% of that, which would have been an additional $11,475 on top of the $18,450 for a total of $29,925 of write-offs over the past 6 years. Remember that number. However, I decided to use the standard mileage rate method, and here's why. In my video where I compared the actual vehicle expenses to the standard mileage rate, I talked about purchasing a more expensive vehicle and driving that very little compared to spending money on a lesser priced vehicle and driving quite a bit. You see, I live in suburbia, and I don't just hop in my car and drive straight to my office because those miles are not able to be deducted for your business. The miles you drive from your main primary residence to your main office location, you can't write those off. And what I would do, coming from suburbia, is I would drive all over town, all over my city, all over the county, all over my state, and even in some cases, outside of my state to go meet with clients. So over the past 6 years, I've actually racked up quite a bit of miles on this car, and as of right now, I have over 171,000 miles on my vehicle. Okay, so here's the math. I'll throw some numbers up on the screen so you can follow along. The car had approximately 20,000 miles on it when I purchased it used in 2015. So over the last 6 years, I've put approximately 150,000 miles on this vehicle, 75% of which have been documented and logged as business related. So instead of getting an $18,450 write-off in year one, plus an additional $11,475 worth of write-offs for those next 5 years, I've driven approximately, give or take, about 25,000 miles per year. Each year it's been a little bit different, a little bit below that, a little bit beneath that, but that's been about the average. And 75% of those miles driven have been business-related miles. So that's 18,750 business-related miles driven basically for the last 6 years. Now, the standard mileage rate has fluctuated a little bit from 2015 to now 2021, anywhere from 53.5 cents up to 58 cents per mile driven, and currently for 2021 it's 56 cents per mile. So for the sake of this equation and this simple math equation, we're just going to use 56 cents per mile driven. That equates to a $10,500 write-off per year for the last 6 years, which is $63,000 worth of write-offs for a vehicle that I purchased for $24,600. Not too shabby. Now, prior to making this video, I did read through Section 179 again, as well as IRS Publication 463, Chapter 4. So if you're in a similar situation as myself and you own and operate a pretty decent quality used vehicle that you think will require somewhat very little maintenance, but you're gonna drive the heck out of that thing, then you may wanna actually do the math on your own and run your own numbers, because yeah, you might not get a big write-off in year one, but using the standard mileage rate method, you potentially might get better bang for your buck over the lifespan of the vehicle over the long term. One thing you want to be careful of, though, is in that 56 cents per business mile driven, there's a certain portion of that 56 cents that is specifically allocated toward vehicle depreciation, and specifically vehicle straight line depreciation. So one of the ways I was able to get such a nice deduction over all of these years is because the basis of your vehicle is not just the sales price. So I've got a clip right here from IRS Publication 463, Chapter 4. I'm going to read it to you now. To figure your unadjusted basis, begin with your car's original basis, which generally is its cost. Cost includes sales taxes, destination charges, and dealer preparation. Increase your basis by any substantial improvements you make to your car, such as adding air conditioning or a new engine. Now, most of you aren't crazy like me and holding onto a car for over 6 years, but if you are going to do that, and if you are going to hold onto a car for this long and using the standard mileage rate method, just make sure that you are aware of your vehicle's basis as you are depreciating it down using the standard mileage rate method and straight line depreciation. Okay, I've got one last little tip for you. Don't hold this to me because I am not sure of the legalities of whether or not this is black and white, not allowed, or if it's kind of in the gray area. So don't hold this against me. I am not a CPA. One of the things that you're going to have to deal with when you depreciate your car all the way down to zero is you're bringing your basis all the way down to zero. So when you dispose of your car, which is a fancy word for basically you get rid of it and you sell it, you're going to have to deal with depreciation recapture, because essentially, again, your basis is down to zero, and the car might actually in market value be worth $4,000, $5,000, $6,000 or more. So don't hold this to me. Again, I am not a CPA, but what I've heard of a buddy of mine doing is he actually has sold one of his vehicles to his spouse, who is not an owner of the business that he owns in his name. So he's taking this vehicle, selling it to his spouse, and maybe there's like $100 or $500 purchase price, to the point where you would owe very little taxes on that. And then the spouse goes and actually sells the vehicle for what its market value is worth, which might be about $4,000 or $5,000. So the thing you have to be worried about there is you're basically trying to skirt from paying taxes on this depreciation recapture. So again, I am not a CPA. Again, run this by your CPA to see if it's something that's in the gray area and it's maybe allowed, or if it's not allowed, because I haven't done enough research on it to figure this out for myself. Just something I overheard in conversation from a buddy of mine. If you have any questions for me, let me know in the comments down below. I appreciate your time. See you in the next one.